Hi everyone, today I'm going to give you an easy method to remember which accounts to debit and credit and when. As when I first learned accounting, personally I was confused and would often mix up which accounts to debit and credit. So if you're having the same problem like I did, just remember this simple acronym called DED-CLIC. Now what does this acronym stand for? It means debit if there's an increase in expenses, asset and drawings, and credit if there's an increase in liabilities, income and capital/equity. Now you might be asking, what if there's a decrease in these accounts? Well, all you need to do is just change the debits/credits. So for example, instead of debit, you would credit if there's a decrease in expenses, asset and drawings. And instead of credit, you would debit if there's a decrease in liabilities, income and capital/equity. Now before I show you some examples of how debits and credits work, let me just give a few quick reminders of what's under assets, liabilities and equity. So under assets, there are fixed assets, trade receivables, cash/bank balance and prepayments. Under liabilities, there's bank loans, trade payables, taxes and accruals. And for equity, there's share capital, share premium, and retained earnings. Now onto the working examples. Let's say that Jim bought a computer for $1,000. In the accounts, he would debit fixed assets by $1,000 and credit his bank account by $1,000. Why? Because as he bought a computer, he's increasing his assets. So you would debit the asset account. At the same time, as he's using cash to buy the printer, his cash balance is decreasing. So you would credit his bank account. For the second example, let's say that Pam is taking out a bank loan of $70,000. In the accounts, she would debit her bank account by $70,000 and credit her bank loans by $70,000. Now why? Well, because as she's taking out a bank loan of $70,000, she's actually increasing her cash balance by $70,000. So she would debit her bank account. As also she's taking out a bank loan, which is considered a liability. So her liabilities are actually increasing, and so you would credit her bank loan account. Now for a third example, let's say the paper company sold $50,000 worth of paper, but the customers haven't paid yet. So in the accounts, they would debit the trade receivables by $50,000 and credit the revenue account by $50,000. Why? Well, because as the paper company sold on credit to the customers, this means that the customers owe $50,000 to the paper company. So this would increase the trade receivables account, which is considered an asset. So you would debit the trade receivables by $50,000. As the paper company sold $50,000, so it's actually increasing their revenue. So you would credit their revenue account by $50,000. So in summary, there's only one key thing you need to remember to master your debits and credits, which is this acronym called DED-CLIC. So again, debit if there's an increase in expense, asset and drawings, and credit if there's an increase in liabilities, income and capital/equity. And the opposite is true, which means you would credit if there's a decrease in expense, asset and drawings. And similarly, you would debit if there's a decrease in liabilities, income and capital/equity. So I hope you guys found this useful, and do leave your comments down below. If you have any questions or even suggestions on what you'd like to see in my next video, feel free to comment below also. If you like accounting or want to get better at it, please like and subscribe, as I plan to put out more accounting related videos soon. So that's all. Take care and have a great day ahead.